This stock was once heavily doubted by Wall Street. Now it's becoming impossible to ignore. Uber just reported first quarter earnings, and the stock shot up higher. In this video, I'm breaking down Uber's first quarter results, take a look at the charts, discuss the three biggest risks to the business, and I'll give a one-year price target for the stock. Let's generate alpha. Uber reported first quarter revenue of $13.2 billion, which was up around 14% year over year. Gross bookings, which is one of the company's most important growth metrics, came in at a huge $53.7 billion, growing 25% compared to last year, beating Wall Street expectations. They also reported adjusted earnings per share of 72 cents, beating analyst estimates. Adjusted earnings before interest, taxes, depreciation, and amortization came in at approximately $2.5 billion, up 33% year over year, showing that Uber continues improving profitability while still growing at a strong pace. One thing that really stood out to me this quarter was user growth and engagement. Trips on the platform jumped 20% year over year to around 3.64 billion trips, while monthly active platform customers increased 17%. That tells us demand for Uber's services is still extremely strong, despite economic uncertainty in many parts of the world. Now let's break down the segments. Uber's mobility business, the ride-sharing side, continued delivering strong growth, but the delivery segment was actually one of the biggest surprises this quarter. Delivery gross bookings rose about 28%, while delivery revenue surged more than 34% year over year to just over $5 billion. Uber Freight also showed signs of recovery after struggling for several quarters, which could become another positive catalyst if the freight market improves further. Looking ahead, management gave very strong guidance for next quarter. Uber expects second quarter gross bookings between $56.25 billion and $57.75 billion, which was above analyst expectations. The company also guided for adjusted earnings of around 78 to 82 cents per share. Overall, I think this was another very solid quarter for Uber. The company continues growing revenue at double digits, improving margins, generating strong cash flow, and expanding across multiple business segments. Let's take a look at the charts. Technically, Uber's chart is looking mixed right now. Not terrible, but also not fully bullish yet. The stock is currently trading above its 50-day moving average, which is a positive short-term sign. That tells us buyers have started stepping back in, especially after the recent earnings reaction. But here's the important part. Uber is still trading below its 200-day moving average. That matters because the 200-day moving average is one of the biggest long-term trend indicators investors watch. Until Uber can break back above that level and hold it, I would not call the chart fully bullish just yet. So the way I see it, the 50-day moving average is acting as short-term support, while the 200-day moving average is the major resistance level to watch. If Uber can break above the 200-day moving average with strong volume, that would be a much more convincing bullish signal. But if the stock fails at that level, we could see another pullback back toward the 50-day moving average. Now looking at the RSI, Uber is currently sitting in a neutral to slightly bullish range. It's not extremely overbought, but it's also not oversold. So from a momentum perspective, the stock still has room to move higher. Overall, the chart is improving, but Uber still has some work to do. Now let's talk about the three biggest risks facing Uber stock right now, because while the company has been executing well recently, there are still some major challenges investors need to keep an eye on. The first big risk is competition and pricing pressure. Uber operates in an extremely competitive industry. In ride-sharing, it continues to compete against companies like Lyft and several regional players globally. In food delivery, Competition is even more intense with companies like DoorDash, Menulog, and others all fighting for market share. Competition can lead to price wars, higher driver incentives, and lower margins. The second major risk is regulation and labor laws. This has been one of Uber's biggest long-term challenges for years. Governments around the world continue debating whether Uber drivers should be classified as independent contractors or full employees. If more countries force Uber to provide employee-style benefits, insurance, sick leave, or minimum wages, operating costs could rise significantly. The third big risk is autonomous driving and robotaxi. Now, this one is interesting because autonomous vehicles could either become Uber's biggest opportunity or one of its biggest threats. Companies like Waymo and even Tesla are investing heavily into self-driving technology. If autonomous driving becomes mainstream faster than expected, Uber's current business model could face disruption. Right now, Uber relies heavily on human drivers, so if another company builds a dominant autonomous network and cuts Uber out, that could create long-term pressure on the business. At the same time, though, Uber is trying to reduce that risk through partnerships rather than building the technology themselves, which may actually be the smarter capital-light strategy. Now, the big question, where could the stock go from here? Most analysts maintain a buy rating with an average price target of about $108. Looking at the discounted cash flow model, the base case estimated value for the stock is about $91, and the best case is $163. As for my opinion, I am giving Uber a buy rating with a one-year price target of $130. Here are 3 reasons why I believe it's a buy. The first reason is strong revenue growth and improving profitability. For years, investors criticized Uber for burning cash and struggling to make consistent profits. But that story has changed dramatically. In the most recent quarter, revenue grew 14% year over year, earnings per share grew 44%, gross bookings grew 25%. The company is growing and becoming much more efficient as it scales. What's important here is that Uber is no longer just a growth-at-all-costs company. Investors are now seeing improving margins and strong free cash flow generation, which makes the business much more attractive long-term. The second reason is Uber's ecosystem and global scale. Uber has built one of the largest transportation and delivery platforms in the world. The company now has over 10 million drivers and couriers globally, while Uber One membership has grown to more than 50 million users. What makes this powerful is the network effect. Someone might open the Uber app for a ride, then order food through Uber Eats later that day, and eventually use Uber for grocery delivery, business travel, or even future robo-taxi services. The more services Uber adds, the more valuable the ecosystem becomes, and that creates a major competitive advantage over smaller rivals. The third reason is autonomous vehicles could actually help Uber, not destroy it. A lot of investors worry that companies like Waymo or Tesla will hurt Uber long-term, but Uber is positioning itself differently. Instead of spending enormous amounts building self-driving technology internally, Uber is partnering with multiple autonomous vehicle companies and focusing on becoming the platform layer that connects riders to autonomous fleets. In my opinion, that strategy could turn out to be very smart. Uber already has the brand, the customer base, the app infrastructure, and the demand network. So if robotaxi becomes mainstream, Uber could potentially benefit without taking on all the technological risk itself. For a company still growing this quickly, a forward price-to-earnings ratio of around 21 is relatively attractive. Overall, the bull case for Uber comes down to this. You have a company that is still growing, improving profitability, generating billions in cash flow, and positioning itself for the future of transportation at the same time. If management continues executing well, I believe Uber could still have significant upside from current levels. Thanks for watching. If you enjoyed this video and want more earnings recaps with one-year price targets, please like and subscribe. Until next time, keep earning, keep saving, and keep investing. I own Uber shares through an S&P 500 index fund. This is not financial advice, just my personal opinions. Make sure you consider your own risk tolerance, time horizon, and financial situation before making any investment decisions.